Thanks for joining us today on Market Call. I'm Marella Fernandez. Gordon Reid with us on the show, President and CEO of Reid Investment Counsel. He'll take your questions on U.S. equities. Here's how to reach us. 1-855-326-6266 if you would like to call in. Email your questions to marketcall@bnnbloomberg.ca if you'd like to do that. Gordon, good to see you.
Nice to see you, Marella.
We have heard many different things from the U.S. president almost daily on whether or not the conflict in Iran will continue. Have you positioned differently at all, either before or during the conflict in the last sort of 10 days?
We really haven't. I think there are some tactical opportunities, but the way Reid approaches these things is we look at markets based on different impulses. So we can have economic cycles, which are normal market cycles, which would bring on some change. Event-driven cycles or event-driven issues in the market, we tend to sit back and watch a little bit. And interestingly, Donnie Moss, who runs our Canadian portfolio, wrote a piece in December of 2025, so long before the issues of Iran and this event-driven market occurred, wrote a piece about Reid's stance on these types of events. And if anybody's interested in seeing it, they can go to our website, goodread.com, go to Articles and Insights, and sign up for the articles and with your email address and read that and many other things that we might even talk about today. Okay, so you mentioned that you don't necessarily position differently. For the average investor, what kind of advice would you give them at this time? I would say don't react to what Donald Trump says on a Tuesday because it could change on a Wednesday. And certainly don't change your investment stance. Be a long-term investor. Buy good companies. And these companies are going to act and react autonomously, away from the noise of the day. We might get some volatility, but the end destination is likely going to be very much the same. What about on energy? We saw oil shoot up quite a bit sort of on the weekend and Monday morning. It's dropped back since. Yeah. I'm wondering if you're owning oil, which has been depressed for some time, would you trim at least on that portfolio? Sure. Good question. We do own some oil, primarily in our Canadian portfolio, because in Canada, that's our expertise. Again, Donnie Moss wrote a blog this time on oil. It's on our website and can be accessed, and about how we're positioning in the oil market today. So if you look at oil companies, they haven't reacted the way oil prices have reacted because the market, the smart money, sees this as event-driven. It will come and it will pass. Just yesterday morning, we saw, before the market opened, we saw futures push oil up to close to $120 a barrel. And we closed at, I think, what, $85? Yes, around there. So we had a massive, massive reversal. And I would hate to think that some investors reacted to the highs and the lows and got whipsawed. So again, much more extensive than I can talk about now, but a blog that's on our website, goodread.com, talks about that more fully. Got it. Okay, let's take a quick break. We'll get to the first phone calls for Gordon Reid of Reid Investment Counsel. Again, he'll take your questions today on American equities. Here is both the number and the email address to reach us. We're back in just a moment. Stay tuned. Let's start with an email from Rishi. She has a question today for Gord. She says, what does the guest think of Netflix after the bottom bounce in the last 3 days? Netflix, of course, bowing out of the Warner Brothers bid. Right. And so seems to have generated some momentum after that. But what do you think about Netflix moving forward? Well, it's understandable that they would have a bounce. The market, the street did not like the Warner Brothers deal. And understandably, I mean, this is Warner Brothers would have represented a bolt-on of a low-growth acquisition that would have diluted a stronger company. Warner Brothers would have given them a much larger library, but Netflix is making lots of money on the original production side. So I don't think people liked it, so you see a natural bounce. Now, we're sitting with Netflix today. Would I buy it? Probably not. I see a long-term secular decline in that type of streaming.
Interesting. Why is that?
Because younger people are doing originally created stuff. You look at YouTube, for example. YouTube, surprisingly to some, is twice as large as Netflix. And you look at TikTok and some of these other sort of self-generated vehicles. They're kind of taking over from the traditional production-based platforms. North American numbers are starting to fade, and those are the higher margin numbers. And based on where it's trading on a valuation basis, it doesn't really excite me.
Okay. That was for Rishi for Netflix. Let's move to our first caller. Jim is on the line. He's in Elliott Lake today. Hi, Jim.
Good afternoon to you both. Gordon, I know you don't follow Novo Nordisk because it's a European company, but I'd like to ask you about Eli Lilly. It's had quite a nice run here, short-term, long-term. Do you still think this is a good entry point for it? And if you're willing to even give a general comment on Novo, just because they are such direct competitors.
Sure.
Thank you.
Sure.
Thank you for the question. Can I just get your take on pharmacare, pharmaceuticals in general? It was a space that was pretty pushed back last year and has sort of revived.
Yeah, and we, as you know, had expected it to arrive. The bigger question, I think, was when.
Okay.
And that's always the most difficult question. You can often pick the right trend, but you can't exactly tell when it's going to happen. And then you get into the messy type of issues of, am I holding these companies because of patience or because I'm stubborn? And you hope it's patience. So we've long liked the pharma space. We've long had positions in Amgen, for example, Merck Pharmaceutical, and continue to and are very excited about the fact that the market's broadening and starting to reward these types of companies. To Jim's question about Lilly, I really, and I appreciate you talking about Novo and giving me a bit of an out there, but I really don't think you can talk about Lilly without addressing Novo, and because they're such direct competitors. And it is a bit of a zero-sum game, with GLP drugs, and Lilly's winning the race at Novo's expense. And that's quite apparent, not only in the results, but it's also apparent in the stock prices. Lilly has always been a very, very expensive stock because it's built in the prospects of what GLP-1 could do for the company. It's gone relatively flat for a period of time, even though it's continued to perform well on a fundamental basis, which of course will bring down the multiple, which is encouraging, but it's still a relatively high multiple. We've gone with other companies in the pharma space. Amgen has Maritide, which is a more nascent entry into GLP-1 technology, but if it gets through phase 3 approvals, it's going to be very exciting for the company. And Amgen itself has some very exciting participants in its portfolio. So we've just chosen to do a slightly different approach.
Got it. Okay, let's get back to the phone lines. Arden is on the line in Edmonton. Hi, Arden.
Yes, I'd like to know Gordon's opinion of Pfizer. Would he buy, sell, or hold it? Thanks.
Okay. Thank you for the question. Same space. Let's talk about Pfizer.
Arden, I would sell because I think there are just better opportunities in that space. A lot of the pharmas, without new drugs coming on, are basically just bailing a leaky boat. They're trying to stay ahead and they're pedaling hard. And a lot of it is because they hit the patent cliffs, and you can go back into the mid-'80s when the current patent legislation that affects pharmaceuticals was written and passed by the U.S. legislature. It's tough. And
how long does a patent typically last?
Well,
or does it depend on the drug?
It does depend on the drug, and I think there are different lengths, and most patents aren't simple. there's multiple patents on many of these drugs, and they expire over time. But Pfizer has really tried to keep up through cost cutting, and that'll only take you so far. Cost cutting is additive to the bottom line to a point, but at some point you cut costs to the point where you put your sales in jeopardy. Other companies have been more aggressive on the acquisition side. Amgen, I mentioned, spent $28 billion on Horizon Therapeutics. Merck has made a major acquisition. So we just like other areas more than Pfizer.
Got it. Okay, let's take a quick break. Back with more of your phone calls and your emails in just a moment. Stay tuned. Welcome back to Market Call. Gordon Reid with us today, taking your calls. Let's go to Paul. He's in Prince George, BC. Hi, Paul.
Hi there. Thanks for taking my call. Mr. Reid, a few shows back, you recommended Masttec. It's done very well. I'm just wondering what your thoughts are on it now. That's Masttec.
Yeah.
Thanks for the question. What is Masttec? Tell me a bit more.
They're an engineering company,
okay,
and taking advantage of the infrastructure build in the United States. Well managed, high ROEs, strong growth of earnings. So sweet spot. So we are still an investor in Masttec, and have participated. Our clients have participated, of course, in the growth of the stock price, and we continue to own it.
Okay, so you would hold on to it if it came into question. All right,
yes.
Let's move on then to Chris in Richmond, BC. Hi, Chris.
Yeah, I would like Gordon's opinion on Boeing.
On Boeing. Okay, thank you for the question. Boeing Aerospace.
Things are getting better at Boeing, and of course they had huge management issues. They had huge quality control issues that were obviously very tragic in a couple of cases. And they've straightened things out from that standpoint. But what's happened is that over the last couple of years, it's been built in. The future prospects for the company have been built into the stock. So I think what you're buying now is future success. I don't think that's necessarily guaranteed. I think there are better opportunities where the future isn't fully built into the stock price.
Okay, that was for Boeing and Chris. Let's go to Aaron in Sarnia, Ontario. Hi, Aaron.
Hey, good afternoon. Thanks for taking my call. Gordon, I've been a long-time listener of your work, and back in the summer, I believe you recommended Merck. It was trading around $80. Well, today it's close to $120. So, right. Getting back to the U.S. healthcare theme, what are your opinions on Merck moving forward? I noticed their next earnings per share estimate is trending lower. So, just want to get your thoughts. Thanks.
Okay.
Thanks, Aaron. I'll reference what I said about Boeing. It's a completely different industry, of course, but last summer, Merck wasn't building in any recovery, nor were much of the pharmaceutical space. And to your point, Morella, it was kind of abandoned and people just didn't want to touch it. We looked at it and saw, good quality companies that had really strong portfolios of multiple drugs in the early phases, so phase 1, 2, and 3, and many of them in phase 2 and 3, so nearing entry into the revenue stream. And Merck was certainly one of those. And based on that strong pipeline, we bought and stayed with Merck, and it's starting to pay off now. So we'll stay with Merck. And in terms of revisions to earnings, those are going to jump around a little bit. I don't think that there's anything meaningful that I've seen. Our portfolio managers and research people at Goodread haven't brought me anything to illustrate that there's a problem with the earnings projections. So we'll stay with it.
What kind of drugs are they seeing success in, or could they see success in soon?
Well, mostly oncology. Oncology has been a major theme of Merck's work. And Keytruda is their big blockbuster drug. We talked about patents and patent cliffs. Every drug company has got to face patent cliffs at some point or another. And Interestingly, or ironically perhaps, the more success a drug has, the more impact a patent cliff is going to have. Keytruda, one of the best oncology drugs out there, in the late 2020s, it's going to see that patent cliff. And what we're looking at Goodread is how they fill in the revenue and what they're doing. And they've got a couple of dozen late stage drugs that we think will be enough to keep that earnings progression going.
Got it. Okay, let's get back to the phone lines then. Kate is in Calgary with a question. Hi, Kate.
Hi.
Go ahead.
I was wondering if you have any insights on investing in the military defense sector.
Yeah, that's very topical, Kate.
I imagine a lot of these would have run already.
They have.
Okay.
They have. And you know, you can look at the pure military hardware companies like Lockheed Martin.
Mm-hmm.
We have chosen to go with a bit of a hybrid in RTX. RTX used to be Raytheon, and then before that it was United Technologies. So United Technologies acquired Raytheon. About 2/3 of their revenues comes from the commercial side, 1/3 from the military defense side. They're most noted for the production of the Patriot missile. So we're participating, but we're not hitching our wagon to something that is, you know, a complete all or none, you know, situation. They're trading, well, they've done extremely well. And when I look at what they're trading at, there's a slight premium to their historical multiples, trading at around 30 or 31 times this year's earnings. And for that reason, I trimmed it. About a week or 10 days ago, I took about 30% of our clients' holdings off of RTX.
Just on valuation.
Just on valuation. Because, of course, as it did well, it became a greater and greater percentage of our portfolio. And we like to keep things in balance. So I trimmed Raytheon. Nothing to do with the fundamentals, everything to do with good portfolio management.
Okay. Let's take another quick break then. We will go through some of the past picks from Gordon when we come back. Stay tuned. Welcome back. Time to have a look at past picks from Gordon Reid from March 18th, 2025. So just about a year ago. At the time, Gordon chose Citigroup on the New York Stock Exchange at 70.22 US, up to 108.05 today, a return of 54%, 57% total return. I imagine you're holding it, but do you remember a year ago why you looked at Citigroup and saw some growth there?
Sure do. It was an obvious turnaround opportunity. And, you know, they were in the doghouse for a reason. They had been mismanaged. They were in geographies that were not performing well. They didn't really have a focused identity. Jane Fraser came on as the new CEO, and she had been in the seat for maybe a year, and I could see changes. They were doing things. They were getting more focused, and we thought that was going to translate into better results, and more importantly, perhaps, a better reputation within the market, which would expand their multiple. And that's exactly what's happening. And I'm not using the past tense here because it's still ongoing. And to your point, yes, we still own it because we think that there's an opportunity here. They still trade at a discounted level to their book value. They're trading at about 90% of their book value, trading at maybe only about a 15% premium to their tangible book value. So very inexpensive historically, doing good things in terms of creating shareholder value. We think they'll earn $10 a share this year, which puts their multiple at just over 10 times. So yeah, we're excited about Citi and continue to own it.
It sounds like you'd put more money in today if you were going in that direction.
We're fully invested in that particular name.
Mm-hmm.
So any client who comes to us as a new client would be a purchaser of Citi in our portfolios.
Okay, and it's already been up more than 50%. Let's get to General Motors, a past pick here. GM on the New York Stock Exchange, 48.67 US, up to 75.84 today. So 56% return, 57% total return. So we should mention that your first two stocks here over 50%. Your last one, not quite as high, Gordon, but pretty good in general. Okay, General Motors obviously has been affected by tariffs and changes in sort of EV mandates in the U.S., that kind of thing. A year ago, when tariffs were still very much a concern, you picked this as a top pick. Why?
Well, we were actually 2 weeks before
Liberation Day.
Liberation Day, when, all heck broke loose. And General Motors still was a pick of ours because on a valuation basis, it was extremely inexpensive, well managed. Mary Barra has done a fabulous job. They've pivoted from the electrification theme back to the ICE engine very nicely. And they're making, good money. They're going to earn $11 to $13 a share by their own estimations. So, sort of the same conditions are here today that were there a year ago, undervalued. And we think that they're going to continue to do well.
Okay, that was for General Motors. Let's go to your last pass pick from March of last year, StoneX Group, which is a financial services network company. They had a 3-for-2 stock split, 113.51, so 108.19 US. Today, that's 43% up. See, you're sliding on this one, Gord. 43% under 50 here. 43% upside for return and total return. What did you do here? Have you held on?
We have, and we're a little bit confused, perhaps, at the slide from 130, because this is a company, a financial services company, that does well during times of turmoil, and that's where we are. I think the likely explanation for the slide from 130 is that they are a small financial services company, and there's a lot of uncertainty out there, especially in financial services stocks. What's under the hood? We've talked about...
Because of private credit concerns?
There's private credit concerns, but I think there's uncertainty because people don't know what might rear its head. And at times of great uncertainty, they sell first. And I think that creates a very nice opportunity for StoneX today. So we're continuing to be an owner. We're watching their fundamentals. Their last earnings release was very strong. It reflected the fact that business was up because of volatility in the market. They do a large business in risk management techniques, trading platforms, options, futures, that type of thing. And we think it's going to continue to perform well on a fundamental basis. We'll let the price take care of itself over the long term. It rarely gets it wrong.
Got it. Okay, let's take a quick break. Getting back to your phone calls and your emails when we come back. Stay tuned. Welcome back. Let's go to an email from Steve. He has a question today for Gordon Reid. He says, what are your thoughts on investing in JP Morgan? We talked about Citigroup as one of your past picks. I'm wondering, I know a lot of the Trump administration rules and regulations will ease up this year. That should help financial institutions. JP Morgan and the space in general, if you don't mind.
Very constructive.
Okay.
You're exactly right. A lot of the regulations are lessening, which will allow them to do more and more business without the administrative overhang and cost. Capital markets business is just at the surface.
Sure.
I mean, it's just wanting to happen because there's so much good happening in the U.S. economy. There's so many opportunities and so much opportunity for combination or sale. And big banks are going to be right in the middle of it with their capital markets business. Their yield curve is steepening, which is a tried and true way of making money for banks. And that's certainly happening. So a lot of good things under the surface for the banks hasn't really been reflected. There's right now worries about private credit. My views about private credit are that inevitably, if you go without a financial crisis, and we really haven't had one for, well, pushing 20 years. I mean, it's say 18 years. People get, complacent, and they start to look more on the reward side than they do on the risk side. And inevitably, accidents are going to happen and that type of thing. But these big banks are well protected. A lot of what came out of 2008 was greater regulation, more oversight, more buffer for banks, and in terms of what could happen in terms of a mistake happening. So they're in good shape. Private credit market represents about 1% of the total fixed income market. There are issues there, without question, but I would see them as likely more isolated. It's going to affect liquidity more than solvency.
Okay. Let's get to our next caller then. We have John, who's on the line in Winnipeg with a question. John, go ahead.
Good morning. Thanks for taking my call. I'd like to ask you about Visa.
Yeah.
It seems around June the 17th, it cracked, and the chart is now declining. It's down about 15% from its highs of about 360. Mm-hmm. What exactly do you think is going on? Is this a tariff issue? Is it an economic issue? I don't understand why it would be dropping like this.
Yeah.
Okay. People have enjoyed Visa for a long time, moving up.
Exactly. And I think John's sort of hitting on it in terms of the economic issue. There are worries out there that the economy is perhaps late cycle and going to crack. Lots of worries about the consumer. Now, the numbers that are coming out on the economy and from Visa itself are not supporting that thesis. Their business is growing very nicely. They're growing transaction volume in the high single digits, 7 to 9%, which is pretty good. A little bit of inflation helps Visa because it raises prices and they make money off higher volumes. So they're in a good spot. Their multiple has re-rated down to the lower end of its historical band, which I see as an opportunity. And in the short term, I would say you should look at markets as being affected partially by psychology. And one can take advantage of that psychology, but long term, it's going to be driven by fundamentals. It's going to be driven by what that company is doing today and planning for the future.
By psychology, you mean emotion, generally? Yeah. Emotion-driven, and then just buying the dip.
Exactly, and that emotion-driven opportunity often comes at the time of greatest uncertainty, of course. And where are we now? Can't say we're at the greatest point of uncertainty because one can't tell you what's happening tomorrow.
But it's a greater point than we've been in for quite some time.
Yeah. Exactly, and this is a time when you look at these companies and make a decision on whether it's a good company, growing well, organically sound, and step in.
All right, let's get to our next caller then. Al is on the line. He's in Masttec, Ontario. Hi, Al.
Hello, and good afternoon to both of you. Mr. Reid, every time you're on, I call in and ask about the same company, Uber Technologies. It's had a bit of a rough ride lately. What are your thoughts now?
I think you've liked Uber before, yes?
Yes,
okay.
Yes. Yeah, we like
Uber.
You still? We do. It's in our large cap portfolio. It has had a bit of a rough ride. This is a stock for the future, and the market has been on board and jumped off board, but in the long term, they are going to be a participant in a growing pie. And whether it's autonomous vehicles, whether it's advertising, whether it's food delivery, freight, they have so many opportunities out there, and they're not trading expensively. Again, I'd go back to my comments on Visa. If you like the long-term thesis, step in when it costs you less money.
Are they partnering, I believe, as well on driverless cars?
They are.
Because obviously people are very excited about that.
Yeah, they have a number of partnerships. Perhaps the best known would be with Waymo. So they are not going to be left behind. They are planning for what is inevitably going to be driverless vehicles, autonomous vehicles for part of their business. And you have to think about rideshare. What happens when you have an autonomous vehicle? The car runs 24/7. Drivers get tired. Autonomous vehicles do not get tired. You're not paying the driver, so your cost per mile starts to drop dramatically. There's a blog on our website. I've gone to this a few times because there's a lot of things on our website that people could read going back even years if they're interested. Uber is one of them, and we lay out our rationale for why we like this company today and in the long term.
Okay, let's take another quick break. Back with Gordon Reid to answer your questions in just a moment. Welcome back, and thanks for joining us. We have an email from John who says, any updated thoughts on Broadcom? Broadcom, of course, did just report and has done fairly well, but we haven't talked really much about tech. It's kind of taken a backseat when everything else has been going on. Where are you landing on some of the tech stocks these days?
Tech has done incredibly well over time, but the market has started to broaden out. And if you look at for example, the S&P growth sector versus the value sector, what you see is a complete divergence. So value so far this year, and in fact it started in 2025, is outperforming the growth side. And these things will cycle, but growth had a good long run. Interestingly, what's happening is that these tech stocks are doing so well fundamentally that when they take a back seat for a little while, all of a sudden they become compelling valuation stories. And we're stepping in a little bit there, and I have a top pick that reflects that. As it pertains to Broadcom, fabulous company. It's done incredibly well in the chip area, most notably in the TPU area, the tensor processing unit, and you know is here to stay, trading at about 30 times earnings. So it hasn't sort of come in from a valuation standpoint as much as some of the others, but you can't deny that it's a great company and has been a great stock. I think it's up sevenfold in the last 5 years.
What about software? Of course, everybody has concerns about software and AI eating its lunch. Some of the software stocks have come back,
right? But
have you pivoted at all in software?
We have some software-related stocks. There's no question that AI is going to be disruptive, and certain stocks in the software area that were thought even as recently as a year ago to have a very wide moat are proving not to have that. But what the market, I think, is now recognizing is that these software companies are not just throwing up their hands and say, okay, we give up, we're going to go out of business. They are pivoting. They are working hard to defend what they have and to create moats for their businesses. So you've got software companies that are using AI to build the software, and that's starting to be recognized.
Okay.
So the death of software, I think, is a little premature.
All right, let's get to an email from Stavros. Tech-related question here. I would like Mr. Reid's opinion on Oracle, which does a report after hours today.
Right.
What do you think about Oracle? Well,
you can see the mountain that has been created, and that mountain was created on the upside by their deal with OpenAI. And it was a great deal, but a couple of things have happened on the downside of that mountain, and that is people are saying, well, are all these funding obligations or promises going to be fulfilled, especially with OpenAI, because unlike some of the hyperscalers, they don't have sources of cash flow that like a Meta does or a Google has. So that's one issue. And then, of course, Oracle as a software company has been very, very aggressive. Larry Ellison has never been shy. He has a huge amount of debt attached to his business.
New debt with the Warner Brothers bid.
Exactly. But a lot of that isn't Oracle connected. Sure. That's more personal. But he's an aggressive guy, and it's worked for him, obviously. It's worked very well. But when the market's very nervous, they're going to shoot first. And that's what they've done. So they've created that mountain chart for Oracle. We'll see what happens tonight. I wouldn't be surprised if Oracle has a second coming, but Goodread doesn't own it. And there's many opportunities out there, and we'd rather choose some of the ones that are perhaps a little more conservative, a little safer than Oracle is right now.
Okay. Let's go to another email from Dave. He said, I'd like to ask Gordon if now would be a good time to take a part position in Home Depot. I've held a Home Depot in the past and exited last year in the 425 range, and I'm looking at it again right now. We'll pull up the chart for Home Depot in just a second. Yeah, I mean, it did well, I imagine, during COVID.
Yes. And
people are at home, and then it's kind of fluctuated since. Do you like Home Depot right now? It's quite down.
Yeah, it's a bit of a show-me area. It's obviously related very, very clearly to the consumer. What's going to happen to gas prices? Where's the marginal dollar going to go? These are questions that we don't really have an answer to. But even before the events that precipitated the rise in oil prices and gas prices at the pump, it wasn't an exciting story. You're looking at perhaps 2% growth of revenues in this space, Home Depot and Lowe's. So it's not a Home Depot specific story, it's a sector or an area story. And that's just not very exciting for a company that's trading at, certainly at a premium to the market, probably 23 or 24 times earnings. So we would pass on Home Depot at this point. Good company, but it's not the time for us.
Okay, let's take a quick break. Then we will get to new picks from Gordon Reid when we come back. Stay tuned for that. Join us tomorrow for Market Call. Bruce Murray will be with us on the show, CEO, CIO of Murray Wealth Group. He'll take your questions on North American and global equities. That's tomorrow. And if you miss Market Call, you can check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from Gordon Reid. We're going to start with Bank of America. On the New York Stock Exchange. We talked a little bit about Citigroup, which is a past pick. Yeah. What do you like about Bank of America?
Well, we talked about Citigroup. We also talked about JP Morgan. And I'd say that in terms of seniority, JP Morgan is the most senior, one of the best banks in the world. Citigroup is an up-and-comer, trying to recapture some of its past glories going back decades. Bank of America kind of in the middle and doing well, more sensitive to net interest margins, a steeper yield curve. If you look at loan growth, very, very strong, doing well. Total deposits doing well. Interestingly, not only Bank of America, but all of the banks are finding that their credit experience isn't deteriorating, it's improving. Okay. And I think that's contrary to what most people would think is happening right now. Doesn't mean that it might not deteriorate sometime in the future, but as we speak today, it's improving, and that makes all of the money center banks very attractive. They're attractive on a valuation basis because they've given up, some because of the private credit woes and worries, I'd say, not woes. And it's a good entry point for
any valuation concerns for Bank of America?
No, in fact, I think it's trading at the lower end of its historical valuation band, even though the fundamentals are superior to its history.
Okay. Let's get to your next topic then. Liquidia, LDQA, on the NASDAQ, and it's a biotech company. Tell me a little bit more about it.
This is an interesting company. It's a small company involved in a rare disease called PAH, pulmonary arterial hypertension. So it's a lung disease. Prior to purchasing Liquidity, we owned a company called United Therapeutics. And United Therapeutics, in the same business with a drug that was very effective. It was a very effective investment for us, quite frankly, and our clients. But in doing our research, what we found was that Liquidia had come out with a competitive drug that was superior, and it was taking share. So we switched horses, as you can do in this market, which is one of the great things about the market, is that you can do peer group analysis and change minds and switch horses. And that's exactly what we did. So we sold our stake in United Therapeutics. We've bought a stake in Liquidia. And they're taking share, and we think they're going to take a lot more share. And not only that, but on a valuation basis, they're much superior to where United Therapeutics was and is.
Do they have other things in the pipeline that you like as well?
No, that's
their basis.
Well, they have PAH and then a derivative of that. So a similar disease, a lung disease, but the same theme.
And is that condition widespread enough for them to really do well in that space?
It's not widespread. Only about 45,000 people have the condition. It's not curable. This is a treatment, but it allows people to live longer. So this is a very serious condition that will have dire circumstances. Okay. But in their space, they have an opportunity to do quite well. We think this is about a $4 billion opportunity for the market, and they're quickly taking share. And we don't think that the stock is priced for the share that they're taking and will take.
Got it. Okay, let's get to your third pick. A very well-known tech name, NVIDIA, of course, which makes the chips. Is this a renewed interest in NVIDIA, or have you sort of held from last year?
No, this is a brand new position for us, only days old. And we have not bought NVIDIA in the past, not because it's not a great company, and it's proven to be that, but valuations were elevated. You know, the fear of sort of buying at that high point. But as I said earlier in the show, what's happening is that these companies have gone flat for a period of time from a share price standpoint, but the fundamentals are just powering on, allowing the valuations to fall very, very quickly. The other thing that's happening is the revisions to the fundamentals are just exploding. At the beginning of 2026, it was expected that NVIDIA would make $5.85 a share. The street now thinks it's going to make $8.25. So if you look at a graph of earnings revisions, 26, 27, 28, 29, it's just up and to the right, which is very exciting for a prospective investor.
Okay, so let me ask you the other side of that question, which is in tech and in chip producers, why NVIDIA?
Partly because of the valuation issue. So today it's trading at about 22 times this year's earnings. It grew revenues in its last earnings release 78% year over year. So this isn't a fading story. They are sold out. They are producing better technology, and the data center development is full bore. I mean, these hyperscalers are putting hundreds of billions of dollars into this space, and not doing it blindly. They're doing it because they think that there's a very good opportunity for a return on their invested capital. And NVIDIA is a big piece of this formula.
Got it. Got to leave it there. Gordon Reid, sir, thanks for joining us. Good to see you.
Thank you, Mirella.
And thank you for joining us as well here on Market Call. We'll see you back here tomorrow.